Hey guys, Stock Saturday, and it's a green week for the markets. Only a slightly green week for me, largely due to gold and silver pulling back. Pretty much everything else has been doing rather well. I'm up about 1,000, just over £1,000, about 0.5%. So it's certainly underperforming. S&P's up 2.85% for the week, and the Nasdaq doing a little bit better, 3.45%. I think they said the longest sort of daily streak for both markets in quite a while, about 9 days up in a row. So, yeah, tech stocks and everything, loving all this talk of trade deals without actually a huge amount of substance of any trade deals getting signed. So, yeah, they seem to be wanting to talk the market up, which is a little bit strange. But yeah, some of my stocks sort of loving all of this. Max having a little bit of gain back to back close to my average price. Broadcom, TSMC, and all them are sort of largely going with the market. But yeah, we'll have to see where things go. Getting into earnings season now for a few more of my stocks. Riot Platforms, this is sort of kind of old news because they give monthly updates, so I'm probably more interested in their sort of April update coming, I would have thought, Monday. But this sort of gives you a better idea of costs and profit and sort of where they could be. They have said they're very, very focused on the potential AI HPC deal that they're looking to do for their 1 gigawatt site, or the remainder of their 1 gigawatt site. So, kind of hoping for that to come off. And I think if it does, I would be quite tempted to maybe make a switch for one of the other miners, because Riot certainly don't seem to be in a better position compared to them. So, yeah, they're looking sort of quite poor as we expected for Q1. They have I haven't actually seen where they put this huge loss, but I think they should be down a couple of 100 million on sort of paper losses because they hold 19,000 Bitcoin, and it was down in Q1. So yeah, a little bit strange. I don't think it's this change in fair value of derivative asset, because that's only 41 million. And they have a gain, unrealized loss on marketable securities. So yeah, that all looks a little bit unusual. Everything else sort of relatively small costs, except stock-based compensation. That is a hell of a lot for a quarter. Yeah, unfortunate. And then they give you some costs per Bitcoin stats, which are reasonably okay, I suppose. Cost to mine 1 Bitcoin at 43,000. It's obviously up from last year because we've had the halving. I suppose it's not double the cost of last year after the halving, so you could concede that as somewhat positive. And cost to mine, including miner depreciation, is 81,000. So yeah, I suppose technically they're making a profit at today's prices. I don't think this includes all the sort of marketing, G&A expenses and tax and all that sort of thing. So yeah, it's not a great business. Could really want a sort of fairly sharp move to sort of 120 to 150,000, and maybe I can get out of the miners then, because I'm not looking to hold them all that long, really. So shout out to Lonnie in the Discord and in the comments. Wanted a quick look at Glencore, a company that I've sold a while back and do keep an eye on, to be fair. But this sort of does seem a little bit rubbernecking, to be honest. Looking at a company that is doing pretty poor, that I don't own, and sort of preying on them like a vulture. They're not doing well at all. Stock has dropped a hell of a lot. Basically, the 2024 results came out, I think, in February, and showed that they sort of weren't making much money of anything on the metal side, and coal was sort of in a little bit of a downturn, which is where they got a hell of a lot of their money in 2022 and 2023. So, yeah, the one sort of bright spark that they still have, you would think, is copper going up. It's sort of pushing, $4.50, got to $5, over $5 late last year. But that is down. Their production is down 30%. So the one sort of positive metal that they have is not been particularly good. They're saying Q1 is a low quarter, and things should pick up for the rest of the year. But yeah, 30% down quarter on quarter is not good at all. Cobalt up 44%, but they don't do a lot of that. The bulk of their money comes from copper, zinc, nickel, and then coal. So zinc basically flat, nickel down 21%, and the price is down as well. Production's down 21%, and then price is down. So I expect they're making a net loss on nickel, and then coal down 7%, and again I think the price is down on coal. So not looking good at all. The main reason I got out of Glencore was sort of this continued focus on coal. It was providing quite a large amount of the profit, so they get seen as a incredibly dirty business, which gives you a low multiple. And yeah, basically the other metals that they were in, nickel, you could sort of see as very positive for EVs and things going forward, but the supply side seems a major issue. Indonesia, I think, sort of have private state-owned companies and are just producing an enormous amount of nickel regardless of price. So it just hits the commodity price, and that doesn't look like getting better anytime soon. Zinc isn't a sort of particularly promising market. It's okay, it has its uses, but I can't really see it going crazy anytime soon. And copper I'm bullish on, but they don't seem to make a huge amount of money, whether they've got high cost of production. Looking at their sort of EBITDA numbers and profit numbers, it's never looked particularly good. And then, yeah, while they're saying it's a bad quarter, it's still down 30%. So you can see certainly why they've dropped. And then, yeah, guidance is fairly poor compared to sort of 2024. Copper's down, and nothing else is sort of really looking amazing. Zinc up a little bit, but nickel production down, coal down. So yeah, the price might be way down on Glencore, but it's not something that I'd be looking to buy back in. I want more of a copper focus, really. Saying that, something I do own and is down a hell of a lot, especially on this earnings release, is Evolution, the gaming, well, not gaming, casino company. Everyone calls it gaming, but I see games as video games, not casino activity, but they prefer to call it gaming. They dropped 19% on these earnings, and they're not great, but I didn't think they were sort of 18% or 19% down bad. You've had revenues up 3.9% from this quarter last year. For the year, it's pretty much flat, 1% up. EBITDA slightly down. Adjusted EBITDA, we'll come to those figures, but yeah, net profit for the period. Down 5.4% at 254 million. Yeah, 254 million, but I still thought that was reasonably okay. 254 over 529.44. You're still talking 48.9%, 48.8% net profit margin. It's better than most companies will make. And yeah, there's some adjustments to that that need to be made. So they've noted part of this reduction in revenues is down to sort of Asia being a little bit stagnant because they have cyber security issues that they're trying to resolve. So it's been very, very stagnant for the last few quarters. Asia was sort of one of their growth markets. Europe is struggling a little bit as well, sort of down ever so slightly on last quarter, but down quite a bit on October to December. I don't know whether Q4 sort of is a popular quarter for them. Would have to go back and look at previous quarters really, but yeah, they still look fairly okay. Net revenue, as I say, up overall due to a fairly strong North America, Latin America rising a little bit as well, and other markets. Not sure whether that's sort of Middle East, Australia, or a place like that. But yeah, fairly small amount of revenue, but growing quite nicely, I suppose, on a percentage. And the regulated markets, it may not be sort of great numbers overall, but their share of the regulated markets is up to 45% from 39%. So that is very, very solid. There's companies that only operate in regulated markets that have much, much better multiples than Evolution, which you sort of expect. That is why, someone like Evolution have quite a large portion of their business from unregulated. I call it unregulated rather than illegal because it's mostly in markets where they just don't have specific regulation for it. They're not sort of out there saying it's illegal, but people still see that as a risk. But yeah, net revenue 233 million on the regulated markets, up from 195. So very strong growth, and much higher than revenue growth as a whole. So I thought that was extremely positive. Just looking at the balance sheet quickly then, they have goodwill sort of rising and rising, making more acquisitions, intangible assets rising. They're still sort of building out more of an expansion into new countries, but continuing to generate a hell of a lot of cash. Cash slightly down on this quarter last year, but significantly up from Q4. So very nice. Looking at debt, there basically is none, and you can sort of see total current assets far outweighs total liabilities. And you can see current assets of 2.24 billion far outweighs current and non-current liabilities put together. So that's always a fairly strong measure of financial stability, really. A lot of people will look at current assets compared to current liabilities, but I always like to see current assets outweighing current and non-current liabilities. That's always a nice thing. Or, of course, the gold standard, cash on its own outweighing current and non-current liabilities. So Evolution don't quite have that, but 969 million compared to sort of 1.5 billion, it's not that far off. So I thought that was strong. It's worth noting as well, while they're still acquiring new businesses and sort of having to sift through what they've bought, write some things off, they've still got depreciation, amortization, and impairments. Quite a bit of that is non-cash charges. So 38 million of that, you wouldn't necessarily knock all of that off net profit, or add it back onto net profit to get a sort of adjusted net profit, but you could probably add some back on because these are not permanent charges, although every quarter, every year they seem to be acquiring more businesses, so you are going to have more sort of charges for new companies. So yeah, if it was a one-off and they don't acquire that much, you could maybe add it back on, but it seems like something that will certainly continue. But worth bearing in mind that some of these are non-cash charges at least, and they are doing a hell of a lot of buybacks. So compared to last year, this quarter last year, 211 million shares, now down to 205. So rather nice. So you give money back to shareholders in the form of buybacks, which is obviously very efficient. So moving on to CME Group, my other very high margin company, the highest margin company I have, I believe. they have this sort of very dry numbers only presentation of their numbers, and then they have their more sort of flashy presentation. But just sort of looking at the hard numbers, they come out with balance sheet first, similar to TSMC, and compare this to last quarter, not the same quarter last year, which I kind of like on balance sheet. Does show cash as halved, which is quite a large drop to cash, 1.4 billion, but still looking reasonably nice. Goodwill sort of stayed largely the same. They have no short-term debt. They've got rid of that. So they had 750 million in the last quarter, so that's good. Although long-term debt has increased by about the same amount, so I'm guessing they just refinanced that up to 3.4 billion. So they've got cash of 1.4. Would be nice to see that ratio a little bit nicer, but you know, they're certainly making a fortune, so they can pay that debt rather easily. Total revenue at 1.64 billion, up from 1.487, same quarter last year. So that's rather nice. What is that? 1642 over 1488. So yeah, 10.3% revenue growth, very strong for a company that makes this much money. You're looking at sort of very high operating income, but I do prefer to look at net income all the way down. Obviously, they have to pay quite a lot of tax on making such a high margin. So yeah, net income attributable to common shareholders, 944 million. So again, that is 944 million on 1642 of revenue, 57.5% net profit. I am kind of getting addicted to high margin companies, because it's just very easy to you know, take a little bit of a hit. If you make a bit less, you make 50%, even 40% in worse times, then you know, there's no issues there really. You're still making a hell of a lot of money. But of course, CME Group seem to thrive in the bad times because people are shorting and using derivatives more and all sorts. So yeah, they seem to be very happy. They do give adjustments to net income as well. If you choose to take adjusted net income rather than just straight net income. Amortization of purchased intangibles. So again, some non-cash charges, although they had exactly the same amount of amortization last year. So yeah, this is why a lot of people will not want to adjust that back, because companies like this are always doing acquisitions. So you should probably include them. But yeah, unrealized gains and losses on investments, that can go up and down. So you know, it was down last year, so probably worth just excluding that and taking a constant. And then income tax, I don't know whether you should take income tax off really, but yeah, they show adjusted net income, so 2019 over 1642. So you got adjusted net income of 62%, but maybe should focus a little bit more on just plain old net income, which is very strong. So looking at their flashy presentation to get a better idea of why things are going so well. Prices sort of been continually up, even all through the Liberation Day drops pretty much, and thriving. As you can see, because people are trading more and more derivatives. 9% increase on interest rate derivatives, and that is the biggest category, but is actually up pretty much the slowest out of all of them. Derivatives on equities, I suppose people wanting to short as a hedge and do puts and all sorts. 17% year-on-year change, which is pretty nice. 20% on energy, that's a smaller market. And then commodities, 23%. and FX rates, or FX currency derivatives 17%. And then metals isn't a huge amount, but that is up 8%. So 13% increase in daily volume year on year, which is very strong. Strangely, that you would think sort of an increase in the volume would possibly lead to more than 13% revenue, but yeah, only 10% increase in revenue, and then 71.1% operating margin, 12% earnings growth year on year. So very nice, and a 4.7% dividend, which depends how much they want to pay as a special dividend. Good to see some of the other stats as well. Non-US increasing quite a bit, 10% compound annual growth rate. First quarter of 2025 as well, very much up from 2024. So that's strong. That doesn't even include all of the Liberation Day sort of numbers. The figures before, that we saw here don't include any of that because it's Q1 and Liberation Day started the first working day pretty much of Q2. So I expect these will be very, very nice showing the Q2 numbers. But yeah, good to see non-US increasing. Options, as I keep saying, look very attractive, and you can see everyone else seems to agree. Average daily volume increasing dramatically from 2022 really, and then 2021. Whether sort of COVID has driven that, don't know. They're listing new micro products, so trying to get derivatives into the hands of smaller people and not have sort of such a high barrier to entry. 100 shares, 100 sort of units per contract. They now start doing micro things of 10 units or 1 unit or whatever, and sort of saying basically derivatives shouldn't be something that only the rich can use. So overall, I think they look great. Very high margin and exposure to a very, very broad range of financial markets. Equities, agricultural, commodities, energy, FX. Quite difficult to sort of get much FX exposure elsewhere, unless you're sort of going for banks and things, which I don't really like. A little bit of metals as well, interest rates. So yeah, I love it as a portfolio. So looking at some economic news, we had quite a lot of big impacting news this week. Job openings for March are down quite a bit. Whether this is sort of in anticipation of tariffs, because this was before Liberation Day, who knows? But yeah, then we had UK house price index down 0.6% for April. But the yearly is still 3.4% up, so yeah, nothing too bad there. ADP non-farm payrolls was down quite a lot. They revised last month's down, but as you can see a little bit later, they are in quite contrast to the sort of more official number, the establishment survey, so quite unusual. PCE inflation, or this is the price index, 2.6%. They revised last month's up, but sort of getting towards the sort of 2% target that they want. I think they'll see it as it's not that much above 2%, so they would focus on other things, and they might start focusing on the sort of job side. Continuing jobless claims has ticked above 1.9 million. That seemed to have sort of been a line that it never really crossed. Initial claims as well, up to 241, although that's not that high. And then we started getting some GDP numbers for Q2. I think this was like 2.4% preliminary for Q2, and then just the next day 1.1%. So you could probably see that as a bit of a nonsense figure, really. Preliminary inflation figures in the EU up quite a bit higher than expected, 2.7% on core inflation. And then the non-farm payrolls for the US, official numbers, 177,000 jobs for April. So much stronger than expected, although they revised last month's down, over 40,000. But yeah, 177,000 is still pretty strong. Average hourly earnings not quite as high as expected, 3.8%. But the jobs mainly came from private, which is pretty good to see. Unemployment rate stayed at 4.2%. So yeah, everyone seemed to like this news on Friday. That had a little bit of a nice effect on the portfolio, certainly on the stock side and the invest account. The ISA sort of is a little bit mixed. Some reasonable games. Riot Platforms had quite a nice day, which is good to see. Gold and silver sort of still taking a bit of a knock, but they've risen a hell of a lot, and I think the Q1 results should start to look very promising. And sort of Q2 with gold above 3,000 for hopefully the whole quarter should start to give them a huge boost. On the ISA side, it's largely unchanged. Pan American coming quite a bit down. It's sort of 27 not so long ago, so that has taken a little bit of a hit, but nothing too bad. And the option side is sort of very, very up and down with the gold and silver move. Equinox has taken quite a bit of a hit, it's down about 4 grand. But Coeur Mining sort of down similar percentage, but everything else is largely up. I've been buying a little bit more Hive and a little bit more iron options, and the the red is decreasing. I won't say I'm sort of making money, certainly, but things are looking up a little bit. Hive sort of back into 5 figures. And yeah, Himax looking up a little bit as well. They had a 7% green day, so that certainly helped. And yeah, still got 8.5 grand in cash left. So have to see what I end up buying. It's quite tempting to put a little bit more into Equinox for the sort of 18 months now that I've got over 18 months left to run. I think they can do well, but I'm still making a decision. So yeah, leave your thoughts in comments below. What you guys are buying, if you're making the most of this upswing in the Nasdaq and the S&P, and like and subscribe. See you soon.